Well, the big question now for a pharma company shareholder is that why have we seen such a linear collapse in pharma prices, especially in the US generic market? What happens to all the COVID inventory, God forbid if we don't get the third wave? And what happens to the non-COVID business, which in a sense slumped because nobody was, because very few were going to hospital and the routine surgeries were also delayed. Is this downtick in pharma more like a structural downturn or this is cyclical downturn? Let's debate that with Nithya Balasubramanian, Director and Health Services, India Health Services with Sanford Bernstein, and we got A Vaidheesh, former Managing Director with GlaxoSmithKline Pharma. Nithya, Vaidheesh, good morning to both of you. Thank you for joining us. Vaidheesh, is this drop in pharma or US generic pricing more like a structural downtick, what we saw between 2015 and 2017, or this is like a one-off because of inventory built up?
Yeah, as you rightly mentioned, Nikunj, my personal belief based on what I hear is because of the COVID, there's a drop in demand and there's a lot of inventory pile up. So quite obviously, there's a lot of clearance that has happened. It's also about consolidation of distributorship there. So I guess it's a multitude of factors, but I don't think there's a permanent impact. I think we have to run through this for right now.
Nithya, first, what is your view on this point which I just discussed with Vaidheesh, and where do you think things will stabilize and the uptick will start kicking in?
So to the question of is price deflation in US generics higher now, the answer is yes. Compared to FY21 and FY22 in the first quarter or so, we have seen higher price erosion. However, like Vaidheesh, I do not believe that there is anything that structurally changed that makes me believe that this kind of deflationary environment is likely to stay. I think what has actually happened is one is the slight inventory buildup that we were talking about. But even that we see, if you look at the wholesalers and what they're reporting, that is actually coming down. So I do not expect this to continue the deflationary pressure for maybe more than a quarter or two. And the second thing that's also happened is EconDisc, which is one of the largest sourcing companies for generics, actually split out from WBAD. So what's actually happened is companies have been a little bit aggressive in pricing to try to win the contract from EconDisc. However, I think in the long run, we're expecting EconDisc to hold discounts constant. So if anything, from 3 very large sourcing companies to now 4 is actually a better thing for generics, right? So I do not expect this to hurt generics in the long run either. And we're also seeing some other changes in the healthcare value chain. There is so much vertical integration between the PBMs and the insurers and the specialty pharmacies and your mail order pharmacies, which I think actually augurs well for generics in the long term. The more vertical integrated the value chain gets, the higher control these companies will have over how many generics are actually dispensed. So I think it's actually a positive for generic volumes in the long run.
What happens to the COVID bump up which most of the companies reported? If one works with an assumption, and let's hope and pray that we don't have a third wave, what happens to the COVID inventory? And since the COVID business was a high margin, high turnover business, do you think that the inventory of the COVID business or the COVID, COVID prescription could be a drag for next 2-3 quarters?
So I think from a number of COVID cases perspective, we are expecting it to keep trending down, which means the COVID therapeutics business should also trend down. However, I don't think it's a high margin business at all. If you look at what companies have commented, it's actually coming in at margins that are lower than company averages. So I don't think it's going to hurt margins. However, growth, yes. So for companies like Cipla or Glenmark these are companies that have benefited quite a bit from selling remdesivir and favipiravir, etc. So we do see that as coming down pretty sharply. But I think what should help these companies is also that we are seeing demand recover on the ground. If you look at the data that IQVIA is reporting, we are seeing healthy volume growth, which means that now that clinics are open on the ground, patient footfalls are increasing. Companies should broadly benefit from the demand recovery we are seeing in the market.
Mr. Vaidheesh, would you concur with Nithya that what we are seeing in terms of US generic pricing pressure is nothing but just a blip up and not here to stay for a long haul?
Yeah, so I think Nithya has summarized it well. I think it can't be anything significantly different from what she has mentioned. As we know that uncertainty of COVID exists as of now, but as we see the COVID is trending down in most part of the world, if things don't flare up again, I would say in a matter of 2 quarters, things should stabilize. I don't think any significant difference than what is being said right now.
Right. Nithya, the other overhang that we were chatting about, the last time you were on the show as well, was USFDA inspections. Do you sense that they could perhaps get stricter in the days to come, and this continues to be a big overhang on pharma?
I think there is a bit of an emerging risk given the long hiatus of FDA inspections. There are a bunch of companies where the manufacturing plants have warning letters and they haven't been able to move forward because inspections aren't happening. And products that have been filed from a facility that has a warning letter will not get approved, right? So quite a few companies are struggling, I would assume, in terms of new launch approvals because of their manufacturing plants not being able to move forward from the warning letter or the OAI status. And in addition, for at least some of the companies in my coverage universe, the complex generics opportunity is supposed to materially move the needle in terms of earnings and growth. And complex generics, unfortunately, require a lot of times they actually require a prior approval inspection. Advair, for example, Cipla's Advair might require a prior approval inspection. And if FDA inspections do not commence soon enough, then you are seeing a potential delay in such an important product. So I would say that there is an emerging risk if the FDA inspections do not commence soon. I would say that if travel were to start and inspections were to recommence, I think that would be a broad positive for the industry.
So Nithya, if I can sum it up, what you're also basically saying are those pharmaceutical companies with a higher exposure to the United States are therefore at higher risk.
So I would say that maybe for the next couple of quarters, I am expecting, at least on a YOY basis, I think generic price deflation could be higher, 2Q and 3Q as well. But like I mentioned before, I'm not seeing anything that's fundamentally changing that might make this deflation sustain into FY23 as well. So I do hope that in FY23, the deflationary pressures would actually be much softer compared to FY22. So the companies that have high exposure to US, I think 2Q and 3Q are possibly likely to be soft quarters.
So Vaidheesh, coming to the earnings season that ended, it turned out to be such a mixed bag. You had like a Sun Pharma on the one hand, and the other side you had the likes of, let's say, a Dr. Reddy's. It is time to be selective, and we get that. But a lot of people also believe that one should be bullish on API, that it's a long-term trend and it is here to stay. What are your views?
Well, as you rightly mentioned, that it's a mixed bag, results are mixed bag, but API is definitely is a very big element in the pharma industry, which is emerging as one of the big component for growth for companies which have started working in that. And there is a big support from the government for API. And I do believe that with China a bit of lagging at this point of time due to various reasons, which we are all aware of it. There is a big opportunity, there's a big tailwind that's supporting API manufacturing and also API supplies to various manufacturers for India as well as to the Western world. I do see a big bump up happening, and many pharma companies are now adding API as one of their big revenue and bottom line earners. So I do see a big opportunity.
Sure. Nithya, as we wind down this discussion, would you say that the correction is actually an opportunity for those who've completely missed out on all of last year and this year's pharma rally to actually buy into? And where within pharma would you actually, tilt your preference?
So I would say yes. I think the correction is an opportunity to buy, but certain names, right? So for example, Dr. Reddy's is a company we cover, and we believe that it's actually corrected more than is warranted. This is a company where we do see material launches supporting US margins as well as growth. They have launched generic Kuvan, Ertapenem, they've launched generic Vasipa, all of which we believe are material products for Dr. Reddy's. So we do see both the margins as well as growth turning around second quarter onwards. So for example, Dr. Reddy's we believe is a buying opportunity. Cipla similarly, I think the biggest concern for Cipla has been will they actually be able to maintain the 22-23% margins that they posted in FY21. We do believe that the sales and marketing costs in India will actually come in at levels that are much lower than what it would have been, because we do believe that there are some savings from the COVID, which is likely to outlast COVID as well, even as field operations normalize. So we do believe that those margins are possible, and as the broader market recovers, we do believe Cipla will be able to grow at or above market growth rates. So Cipla, we believe, is also a buying opportunity.
As we come to an end of this conversation, Nithya, I'd just like to go back to API. We got Mr. Vaidheesh's views about how there is still upside left. How are you folks at Bernstein seeing this? If somebody wants to play the API game, what's the best way?
So I will not be able to take names, unfortunately, because I don't cover any of the companies that do largely APIs. But from a thematic perspective, I would concur with what Vaidheesh mentioned. I think the only nuance I'll add is when you're getting registered as a second source, so the China plus one theme, right? So when you're getting registered as the second source, in regulated markets, it can take anywhere between 18 to 24 months, depending on how complex the API is. So which means the China plus one hasn't yet played out, right? What we saw, the significant bump up in revenues and margins that we saw in 1Q and 2Q of last year was actually because of a lot of emerging market consumers shifting sources to India, which we have now seen actually come back down, because those price conscious consumers have actually switched back to China sources. But what we have not yet seen play out is developed market players who have realized that they need to increase the resilience in the supply chain and have started registering Indian suppliers as a second source. That I think will take another couple of quarters to play out. So there is yet more to come in terms of API opportunity.
Okay, so that's one opportunity that certainly exists in the pharmaceutical space. We've seen correction, and we've got two leading experts on that. With that, I'd like to thank both of you for joining us live on today's edition of The Market.